Welcome back again, YouTube. This is Nick the Kid here with another video. So in this video, I wanted to specifically talk about retirement savings, some tips and ideas that I have for you that I think will be beneficial to you and your retirement future. So first and foremost, I want to say that I am not a financial advisor by any means. So please do your own due diligence, do your own research, figure out a strategy and plans that work best for your needs for your future. So if you like this video and it was helpful to you, please hit that like button, hit the subscribe button down below. Let me know in the comments what you think about the video. And if you're interested in me doing any future financial type savings, retirement type videos, I will do that if you guys think that this was helpful. So to start off with investing, probably before you invest, you definitely want to start with having a budget plan with your income, figuring out whatever extra money that you have available left over beyond your normal day-to-day or monthly budget. Um, then the next thing you want to make sure that you do is you want to pay any outstanding debt that you have, any substantial debt. You want to make sure you pay that off before you invest, or at least most of it before you invest. Probably the most easiest, quickest, accessible way to start saving for retirement is into a employer 401k. So if you do have one available, or if you're unsure, talk to your manager, your supervisor, whomever. Ask them if you have a plan. If you do, I'm sure that when you got hired, you got a booklet and everything explaining how to set it up. Please start that as soon as you possibly can. Even if you have older 401ks, you can roll those old 401ks into your new existing plan. So please be aware of that. You're going to want to know the ins and outs of your 401k to make sure that you max out with the best benefits that are beneficial to you and your risk tolerance. So you want to know the ins and outs. You want to know what the investments are. You want to know their previous track record, probably, and you just want to know the general spectrum of what it's invested in. That way, you have an idea, you know what it is, you know what the numbers are, and you can feel comfortable into making those correct investment choices based off of your risk tolerance, your age, and all of those sorts of things. So, the best thing to do is to make sure that you're at least making that contribution of at least the match. So, hypothetical, let's say your employer matches up to 5%. You want to at least make sure that you, on your end, are at least making that 5%. That way, you're not leaving any money on any free money on the table. That is not a good thing, and especially for the long term, it will hurt you big time. So, for compound interest to work, you're going to have time on your side. So, the younger you are, the better. And even though you might say, oh, well, I'm really young, I don't make a lot of money, start now. If you start now and you use the proper investment tools and opportunities that are available to you, it will benefit you well into the future. Your future self will thank you big time. So, like I said, 401k investing, you definitely want to set up a strategy that works for you and your risk tolerance, depending on how old you are, how many years you have already put in, and what amount you have in your balance. That will help you out a lot too. But if you're young, you want to go aggressive as you're willing to go. But if you're middle aged or latter part of your career, you want to be a bit more conservative, but you also want to have a little bit of wiggle room for growth as well too. So you want to really be well diversified, well balanced. So check out your investment options. Talk to an advisor. Talk to the administrator of that plan. See if you can get some helpful ideas and stuff. But do your own research and figure out what works best for you. The next set is just being able to budget and save money in the bank. You're gonna want to have some savings on hand If things get, out of whack or whatever necessary, you want to do things around the house, you want to go on vacation, you want to spend on this, you want to spend that, you're going to want to have some cash on the side, because a lot of retirement vehicles, that's locked in until you retire. So that money, once you put it in there, you can't take it out. But one thing that you can move in and out a lot would be stock market investing. Stock market investing can be very, very exciting. It's very scary, very high risk. But if you know what you're doing and you set it for the long term and you have a long term goal, you're going to make gains on it in the long run. You have to have time on your side. The longer you have of time, the more wealth that you're going to be able to build. And that compounding interest is going to just exponentially grow for you over time. So, an interesting website to check out is www.investor.gov, and they have a compound interest calculator near the bottom of the screen. They have a compound interest calculator. Click that link, and you'll see the different fields that you have to put in. You have to input certain numbers or whatever. But you put in these numbers, and the compound interest calculator will calculate a fixed dollar amount, a set dollar amount that your account will grow to once you get to that retirement age. So please check that out. It's really cool. Move the numbers around, you'll just be blown away by the value of that compounding, and the power of it is just really, really phenomenal. And then if you're like, hey, you know what, I can afford to do more, I can put more in, then go ahead, by all means do that, because the more you're able to put in now, the longer it has to grow and compound. So really, really check that out. It's really cool. So I talked about 401k, talked about stock market investing, and the other side of things is taxes. You want to make sure that you're up to code on your IRS and your taxes and all that stuff. But the IRS limits is your contribution $19,500 to traditional and $6,000 to Roth. So be aware of that. And if you're, wondering like, hey, how can I figure out how to max it out or whatever? Basically, you max out by dividing out how many pay periods you get in a calendar year. And a lot of retirement programs and stuff, they'll let you know if you're getting close to that max, so that way you don't get penalized by that. But if you can max out, by all means do so, because if you know what you're doing and you can strategize properly, your compounding is going to be astronomical. I mean, just really, really huge, depending on how long you have to invest. So be aware of that, and just stay tried and true. Stay for the long haul. Don't freak out when the markets go down. Don't change your investments. Stick with your investments. That's the biggest key loss that people have with their retirement accounts, is that they move it around all the time. You have the availability to do so, but the more you move it around, the farther and farther away you're going to get to those average rate of returns. So like I said, if you're looking for maybe an 8 or a 9% or even 10% return on your investments year after year, you need to stick it out for the long haul. You need to stay strong, stay tried and true, and ride out the storms of the market. That's what's going to get you the benefit, because dollar cost average is what's going to help you, because you get those pay periods every pay period. You could be buying up here one pay period and then buying down here on this pay period. But when you buy down here, you're buying more shares for the same cost basis, and then your dollar cost averaging down. So you're buying more shares for the same price, but then when the market rides back up, then you're going to capitalize even faster and stronger on those gains once the market goes back up. So be aware of that. Don't freak out. Don't be in and out, up and down, and crazy moving your money around. Set it, forget it, lock it in, and grind it out. And another big tip that I have for people: increase your contributions by 1% every year or every time that you get a raise. Bump it up, bump it up, bump it up. You would be very, very pleasantly surprised as to how much you can save if you do that. You would be surprised and you say, you know what, I could really afford to do more, go more, and go bigger. The more you can contribute now, the longer it has to grow and to compound. So I really hope that these are some helpful tips. If you like the video, please hit that like button, hit the subscribe button down below. Happy investing, do your research, stay tried and true. Don't pull your money out when the market goes down. Ride that storm. And happy investing, and your future self will thank you. Thank you guys for watching. Have a good one.